There are two kinds of people in America right now. The first kind is buying rental properties. They are at dinner parties explaining passive income. They feel smart. They feel like they figured something out that most people are too comfortable or too scared to act on. The second kind is quietly putting money into index funds every single month. Nobody asks them about it. Their coworkers do not know. Their family thinks they are being boring and overly cautious. 20 years from now, one of these people is going to look back and realize they traded their time, their sleep, and their peace of mind for roughly the same financial outcome. And the part that will really get you, it might not be the person you think. Let me tell you about two people, Tyler and Ashley. Same city, Charlotte, North Carolina, one of the fastest growing rental markets in the country right now, where real people are making this exact decision every single week. Same age, 32. Same household income, around $78,000 a year. Both of them spent years being intentional with their money and saved up $60,000. And both of them had to make a decision about what to do with it. Tyler did what his dad always told him to do. He bought a rental property. 3-bedroom house, $300,000 purchase price. He put his $60,000 down and financed the rest at 7% on a 30-year mortgage. Monthly payment, $1,596. He found a tenant paying $2,100 a month. On paper, that is $504 a month in cash flow before he spent a single dollar on anything else. Tyler felt like a genius. Ashley took the same $60,000 and put it into a total stock market index fund, set up a $400 monthly automatic contribution, and went back to living her life. Her coworkers asked what she was investing in. She said index funds. They nodded politely and changed the subject. Nobody is impressed by index funds. That is the first thing you need to understand. The social reward for real estate is completely disconnected from the financial reality of it. Owning a rental property gives you a story, an identity, something to point at from your car window. An index fund gives you a confirmation email. But stories and math are two very different things. And when you actually run the full numbers, not the napkin number, not the rent minus mortgage scribbled on a whiteboard at a seminar, this conversation gets a lot more complicated than any thumbnail is going to tell you. For the first couple of years, Tyler is living what he believes the landlord dream looks like. Rent hits his account on the first of every month. He drives past the property thinking, I own that. He is writing off mortgage interest on his taxes and watching his equity grow with every payment. Everything about this feels real, tangible, and smart. Year 1, Tyler collected $25,200 in rent. Mortgage payments totaled $19,152. Gross cash flow, just over $6,000. Sounds like progress. Here's what actually happened that year. Property taxes, $3,200. Landlord insurance, $1,800. One HVAC service call in August, $380. The refrigerator died and the least required one, $1,100. 1 month vacant between tenants, $2,100 in lost rent, plus $700 to clean, repaint, and relist. Tyler's actual net cash flow for the entire first year was somewhere between $800 and $1,200 on a $300,000 asset over a full calendar year. That is less than $100 a month on a 6-figure investment. And here's the part that never makes the thumbnail, the time tax. Tyler is managing this himself to avoid the property management fee, which on $2,100 a month runs $168 to $210 before he keeps a dollar. So instead, he is fielding calls at 10 p.m., coordinating repairs on his lunch break, and spending Saturday mornings at Home Depot. Real estate is not passive. For most individual landlords, it's a second job, one that does not pay overtime and texts you when the water heater breaks. Ashley logged into her brokerage account twice that year. Her portfolio by year end, approximately $73,000. Hours managing it, 0. Here is where most real estate content misleads you. Not by lying, but by leaving things out. Always the same things. Costs that show up later, risks that feel unlikely until they're not, and time that never gets counted because it doesn't appear on a spreadsheet. There's a number repeated in every real estate video, every podcast, every weekend seminar. The gross rent number. The $2,100 headline. It sounds incredible because it's designed to sound incredible. Nobody follows up with what comes out of that $2,100 before Tyler actually keeps any of it.
Vacancy. The national average sits at roughly 1 month per year, one full mortgage payment with zero rental income every year. Over 20 years, that is 20 months of carrying the mortgage alone. At $2,100 a month, that is $42,000 in lost income before anything else goes wrong. Maintenance. Budget 1 to 1.5% of the property's value annually. On a $300,000 house, that is $3,000 to $4,500 every year. Some years it is a $200 faucet fix. Other years it is a $9,000 roof you cannot delay because you have a tenant and a legal obligation. Capital expenditures. Roofs last 20 to 25 years. HVAC systems 15 to 20. Water heaters 10 to 12. These are not surprises, they are scheduled future expenses. If Tyler is not setting aside $300 to $400 a month into a reserve fund, he is not running a rental business. He is running on borrowed time. And then there is the scenario nobody wants to model, the bad tenant. In North Carolina, eviction from filing to physical removal takes a minimum of 2 to 4 months. A tenant who stops paying and knows the process, that is 3 to 6 months of zero income, legal fees, and potential property damage, while Tyler still owes his mortgage every single month. One bad eviction can erase an entire year of operating profit. Add it all up, vacancy, maintenance, capital expenditures, taxes, insurance, and Tyler's actual cash-on-cash return after 3 years is somewhere between 2 and 5%, not the 15 to 20% he told people about at the barbecue. Ashley's portfolio at the same 3-year mark, approximately $103,000. Hours managing it, 0. Now here's where I have to be completely fair, because if I only showed you the downside of real estate, I would be doing exactly what I am criticizing. Tyler has one thing working for him that Ashley simply cannot replicate: leverage. Tyler used $60,000 to control a $300,000 asset. That is 5 to 1. Ashley used $60,000 to control $60,000 in assets. When Charlotte appreciates at 4% annually, that gain applies to the full $300,000 value of the home, not just Tyler's down payment. That's a $12,000 gain on a $60,000 investment in year 1 alone. That leverage is the primary reason real estate has created more American millionaires than any other asset class in history when it is used correctly and in the right market conditions. There is also the depreciation tax benefit. The IRS lets landlords deduct the theoretical wear and tear on their building from taxable income every year, even while the property is actually going up in market value. Tyler might be writing off $8,000 to $10,000 a year. Ashley does not have access to anything like that outside of retirement accounts. And real estate has one strategy the stock market literally cannot compete with: house hacking. If Tyler had bought a duplex, lived in one unit, and rented the others, his tenants would be covering most or all of his mortgage. His personal housing cost drops towards 0 while he builds equity. No index fund does that. But Tyler did not do any of that. He bought in a market where the rent-to-price ratio, monthly rent as a percentage of the purchase price, sits at 0.7%. Experienced investors target at least 0.8 to 1% because that is where the cash flow math actually works from day one. On a $300,000 house, hitting 1% means $3,000 in rent. Tyler is collecting $2,100. The gap between those two numbers does not sound dramatic, but run it out 20 years with all the expenses layered in, and it's the difference between a rental business and a rental burden. Real estate done right, right market, right rent-to-price ratio, managed like an actual business with systems and reserves, is a legitimate wealth-building machine. Real estate done the way most first-time landlords do it, bought for the story and managed like a side hustle, produces the numbers Tyler is actually living with. Let's move the clock forward, because this is where the comparison stops being simple and starts being real. Year 10.
Tyler's property, at roughly 4% annual appreciation, is now worth approximately $430,000 to $450,000. His remaining mortgage balance after 10 years of payments sits around $195,000. That puts his equity, the actual net wealth he holds in that asset, at roughly $235,000 to $255,000. When you factor in everything Tyler spent beyond the original down payment over a decade, taxes, insurance, repairs, vacancy, capital expenditures, his total out-of-pocket investment beyond the mortgage is somewhere between $90,000 and $110,000. Ashley contributed $60,000 up front, plus $400 a month for 10 years, $108,000 total. At a 10% average annual return, which is the historical average for a total U.S. market stock index fund over any rolling 20-year period going back nearly a century, her portfolio sits at approximately $110,000 to $230,000.
At year 10, they are surprisingly close. Tyler might be slightly ahead because leverage amplified his appreciation returns, but Ashley's $220,000 is completely liquid. Tyler's $240,000 in equity requires a sale or a refinance to access, both of which cost money, time, and paperwork. There is also something that almost never comes up in these comparisons: concentration risk. Tyler's entire investable net worth is in one asset, one zip code, one city. If Charlotte's economy shifts, if a major employer leaves, if local rental ordinances tighten, his wealth is exposed in a way Ashley's simply is not. She is invested across thousands of companies in every sector of the American economy. If one collapses, she does not notice. That diversification is not just a financial concept on paper. It is a fundamentally different emotional experience of holding wealth. And for most people, it translates directly into steadier long-term decision-making. Now, year 20. Tyler's property is worth between $600,000 and $650,000. With his mortgage nearly paid off, his net equity lands around $580,000 to $620,000. After 20 years of maintenance, vacancies, capital expenditures, property taxes, and one major kitchen renovation he had to do in year 14 to keep attracting quality tenants, his net operating profit from actually running the rental, money in the bank from rent after every dollar spent, sits somewhere between $60,000 and $100,000 total. Maybe more in a hot market, maybe less if he hit a rough stretch. Tyler has genuinely built real wealth. His equity is real, his asset appreciated significantly, and leverage did exactly what leverage is supposed to do over a long horizon. Ashley contributed $156,000 total over 20 years, $60,000 up front plus $96,000 in monthly contributions. At 10% average annual return, her portfolio is sitting at approximately $540,000 to $580,000. More than $380,000 of that is compound growth she never had to do a single thing to generate. At year 20, Tyler and Ashley are in essentially the same neighborhood of total wealth. Tyler built his through leverage, appreciation, and 20 years of active management. Ashley built hers through patience, consistency, and compound interest, and she has never once had a tenant, a contractor, or a 10 p.m. emergency. Now, here's the number that quietly changes the entire conversation. If Ashley had increased her monthly contribution by just $200, bringing it from $400 to $600 a month, her 20-year portfolio crosses $720,000. That extra $200 a month, which is less than most Americans spend dining out every month, produces an additional $140,000 in final portfolio value through compounding alone. In the stock market, contributing more has a multiplied effect because every additional dollar compounds on itself all the way to year 20. In real estate, investing more means a second mortgage, a second set of tenants, a third roof, and a second set of late-night phone calls. The scaling difference between these two strategies is not just financial. It is a question of how you want to spend your hours. Before I wrap this up, I want to be clear about something, because the stock market is not the clean, effortless answer either, and anyone who tells you it is has never watched a significant portion of their savings disappear in real time.
In 2008, the total U.S. stock market dropped roughly 50% from peak to trough. In March 2020, it dropped 34% in about 5 weeks. If Ashley is watching $200,000 become $100,000 on her phone screen, that is not a number on a screen. That is a physical sensation in your chest. And decades of behavioral research from a firm called Dalbar consistently shows what the average retail investor actually does in that moment. They sell near the bottom. They wait until it feels safe again, and they buy back in at higher prices, locking in permanent losses at the exact worst time. The behavior gap, the difference between what the market actually returns and what the average investor captures after accounting for their own panic, costs the typical retail investor 1.5 to 2% per year. Over 20 years, that gap is staggering. Tyler's property also dropped in value in 2008, but he didn't see it in real time. There was no notification. His tenant kept paying rent. The house was still standing. So Tyler kept owning it, not because he was disciplined, but because the structure of the asset made it very hard to panic sell. The illiquidity of real estate, which feels like a disadvantage, actually protects most people from themselves in a way that a brokerage app never will. There is also no monthly cash flow from an index fund. Total market dividends run around 1.3 to 1.6% annually. On $200,000, that's roughly $220 to $260 a month. That's not replacing anyone's income. It's not creating financial independence before traditional retirement age.
Here is the honest conclusion. Know yourself. If you are the kind of person who would panic sell in a market crash, the structural discipline of owning real estate might produce better long-term outcomes for your specific psychology, even if the raw numbers point somewhere else. If managing tenants and properties drains you and your time genuinely has high value, the index fund path is cleaner and scales without limits. Neither of these is a universal answer. Both of them require you to be honest about who you actually are and how you actually behave when things get uncomfortable. One thing I want to flag before I close this out, because it is directly relevant to anyone watching this who is leaning toward the Tyler route right now. The American housing market has shifted significantly in the last 2 years. Mortgage rates climbed to levels not seen in over a decade. The rent-to-price ratios that made certain markets viable in 2021 and 2022 have changed. Inventory has moved, and the dynamics of what makes a rental property actually work financially in 2025 are meaningfully different from what most landlord playbooks were written around. We already did a full breakdown on exactly what happened, the rate environment, the price story, what it means for anyone thinking about buying right now. Watch that before you make any decision. It is linked in the description and it will pop up on your screen right now. If this breakdown hit differently and you want to keep understanding money the way they never taught you in school, please like the video so that it reaches the right audience and subscribe to Decoded. We decode the psychology, the systems, and the real mechanics behind wealth, so you stop reacting to your finances and start understanding them, one video at a time. See you in the next one.